Thank you very much for joining us this morning. My name is Steve McMenamin, and I'd like to welcome you to today's event as part of the ongoing series of the Greenwich Roundtable. Our topic this morning, Psychology of the Markets, Lessons from the Fall, is a continuation of our examination on the soft aspects of investing. This topic is also very much needed therapy session. We try to wrap our brains around what just happened and what's likely to happen going forward. Today we've decided to bypass the practitioner and assemble only the experts. We've got three of the leading thinkers in market psychology and emotion. I'll briefly introduce them. I also should say that speakers' views are their own and don't necessarily represent the views of the Greenwich Roundtable staff, the board, or its members. Richard Zeckhauser is a professor of political economy at Harvard's John F. Kennedy School of Government. Professor Zeckhauser pursues an eclectic mix of conceptual and applied research. The primary challenge facing society, he believes, is to allocate resources in accordance with the preferences of its citizenry. Financial markets and health risks are subjects of his major empirical investigations. Among the many honors and positions he's earned, some of his most recent research includes axioms and algorithm for reputation systems, as well as recommender and reputation systems. Keep your eye on this man. He's original and he's authentic. Dr. Ari Kiev is one of the world's leading trading coaches, as well as a psychiatrist and author. Dr. Kiev was the first psychiatrist to be appointed to the U.S. Olympic Sports Medicine Committee, where he was working with Olympic athletes in peak performance coaching. Ari has written some fascinating books that I'll be ordering on Amazon after this session. Some of the titles are Mastering Trading Stress, How to Inspire Peak Performance from Traders and Money Managers, and The Psychology of Risk, Mastering Market Uncertainty, a strategy for handling executive stress, and an anthropological text called Magic, Faith, and Healing, Studies in Primitive Psychiatry Today. Sitting to Richard's left, Jason Zweig is the investing and personal finance columnist for the Wall Street Journal. He is the author of Your Money in Your Brain on the Neuroscience of Investing. Jason is also one of the few journalists on the planet who actually understands the principles of investing. Jason is here today through an introduction by John Griswold. This is also his understanding of the principles of investing is evidenced by his being selected as the editor to revise Benjamin Graham's The Intelligent Investor, which Warren Buffett has described by far the best book about investing ever written. Before the Journal, Mr. Zweig was senior writer and editor for Money and Forbes magazines. Like his colleague Mr. Deas, Jason is original, honest, and authentic. And the moderator of the roundtable today is Ben Alamansky. Ben is in charge of all opportunistic investment strategies at the Glenmead Trust in Philadelphia. He's one of the brightest lights in the business, as evidenced by his co-authoring our best practices in hedge fund investing study on due diligence for global macro and managed future strategies. Ben's a member of our programming and education committees. Please welcome Ben as he sets the table for today's discussion.
Thank you very much, Steve. It's interesting. This panel was originally intended to explore the psychology behind investment decision making, and I guess we first talked about the idea for the panel back in November. Over the past few months since this topic was conceived, we've seen obviously continued deterioration in markets, massive stimulus not only from the U.S. but all around the globe, and actually another what I sort of put in quotes a dark side of this crisis. The exposure of frauds, including Madoff, Dreyer, and Sir Alan Stanford, as we've seen in the paper in the past few days. And so really there are just a whole number of behavioral aspects of investing that I think we're going to cover this morning. We have a lot to cover. So I'd like to kick off with Ari, who will discuss the effects which stress and uncertainty have on investors and how anxiety and stress influence decisions. Ari?
Thank you very much. And we're all familiar with stress. We all experience it throughout our lives. And the trading world is inherently stressful. And the past year and a half has been particularly stressful. The question is what happens when somebody's under stress. there's a book that I just started reading called Deep Survival by Lawrence Gonzalez, which I highly recommend, where he talks about how people who are out camping get lost, go into panic, and then create a kind of self-fulfilling prophecy where their behavior is governed more by the panic and their confusion and their loss of an ability to create a map of where they are, or even to, what he says, be here now and just settle in, like the fellow on the Survivor program on TV who first thing he does is makes a fire and settles in and starts appreciating the situation he's in rather than trying to get himself out of it and then begin to make a lot of irrational decisions. Well, to the extent that a trader is under stress or has had a big drawdown and is even more stressed and is fearful about what's going to happen, his decision-making begins to go awry. He starts holding on to positions that are going against him, hoping against hope they're going to turn around, or he doubles down. On the upside, he is so uncomfortable that he gets out of his positions just as they're starting to work. And instead of maximizing his risk in situations which are going to produce profits, he tends to minimize them, taking more risk on the losing side, in line with what Kahneman writes about in Prospect Theory, for which he won a Nobel Prize. People are hardwired to take more risk in riskier situations than in more positive situations. And the best traders are the ones who've been doing this for 20, 25 years, who've learned to somehow or other detach themselves from their own emotional response, which is what we were talking about before, so that they're not doing what they're hardwired to do. They're doing what they've learned to do, either through meditation or yoga or some kind of practice which allows them in the stressful situation to recover or return to a kind of more tranquil, meditative state where they're able to see the distinctions in front of them rather than react to their own emotional response and their own misinterpretation of events. What happens also during these periods of time, reflected by a Swiss hedge fund manager who came to see me recently, he was running about $1.8 billion, and he lost almost all of it. He left with about $100 million, and is totally focused on what went wrong and berating himself and convincing himself that he won't be able to do it again. And every time he talks to an investor, he feels compelled to get into a kind of hand-wringing kind of confessional, as opposed to looking at what he did wrong, how he failed, and what he can do going forward in a more positive light. So we began to look at his personality. We did some personality tests. We reviewed his life experience. And it turns out, this is kind of the kind of inquiry that's necessary, that the last thing in the world he wanted to do was to manage an organization. He really wanted to trade. And as the firm expanded from $100 million to $1.8 billion, he began adding people, many of whom were not equipped to do the job they were hired to do, many of whom were not equipped to complement his skills in the sense of hiring a COO who had interpersonal skills, who was good at hand-holding, was willing to kind of work with people, hiring a risk manager who was a quant but had very introspective, somewhat passive personality and was not able to make forceful decisions or be proactive in dealing with people. So it becomes clear that while he was skillful in creating a lot of successful investments and understanding the game, he didn't understand the organizational issues required, which is not an uncommon thing. Wrote a book last year called Hedge Fund Leadership, and went out and talked to a lot of hedge fund managers, many of whom said, I was running $3 billion within 5 years, in contrast to people in industry who, by the time they got to be CEOs, were really had been doing it for 30 years and really understood what the requirements were for those kinds of jobs. So the hedge fund world is really made up of a lot of people who are skilled at stock picking, but not necessarily skilled at managing others or managing themselves vis-a-vis others. And these are kinds of considerations that you really want to get into when you're kind of thinking about investing with a manager. Does he understand risk? Does he understand risk metrics? Is he doing what somebody told me they were starting to do the other day? Not only look at the winning percentage, with 60% as a kind of target for the year, but the win-loss, the slugging ratio, averaging, where the average wins are greater than the average losses with a ratio of something like 1.5. He's now looking at win-loss ratios and percent of winning trades, idea by idea, strategy by strategy, so as to be able to demonstrate to his traders and PMs that they may not be taking as much risk in their high conviction ideas as they could, and therefore not making as much profit as they could. Other people are looking at things like volatility, and with the increased volatility, they're being more and more uncomfortable about trading, taking risk, but recognizing that with the volatility, you don't need to have as much money to have the same VAR, so that there's a chance to use less capital in a kind of protective sense, at the same time take advantage of the volatility in the marketplace. So what I've been seeing is that the least experienced or the least successful have been people who have stayed wedded to their ideas and not responded to the market forces, or not responded to the fact that fundamental analysis is not working as well these days. And it really became necessary to pare down, stay only in high conviction ideas, and not really be that heavily invested even in the high conviction ideas, waiting, developing patience, and waiting until such a time as the market turned around, not trying to get it all back right away. So there are a lot of these kinds of lessons that people have been learning and some people have been applying. But I think that gives you a sense of an idea of what's going on, that the best people have been willing to say which of our strategies have not worked, which are the instruments we've gotten involved in. I know one firm that got out of fixed the currency and rates and stuff like that, because that was not really the strength of the firm. And it's concentrating on long-short. And then within that framework, looking to see what kind of missed opportunities there were, because some of the ideas were not adequately covered. And what do you do to change the culture of the firm in terms of increasing communication amongst all the people that are doing very fundamental, deep work? Thank you.
All right. One of the things that we talked about before we started the panel this morning was, are there some lessons that we as investors can use to keep ourselves focused? This is slightly different than what we were talking about with respect to due diligence on managers. But just for all of us who are investing, whether in stocks individually or putting money with managers, who might be doing fine in this crisis, how can we kind of keep ourselves focused on it?
I think the first principle, I believe, is that you've got to have a frame of reference. You've got to have a target. Not, I just want to do as well as I can. I want to earn X amount per year. I want to earn 20%, 30%, 40%. I talked to a guy recently who did 40% last year and was somewhat disappointed because somewhere along the way he began to get the feeling that maybe he didn't deserve to do as well as he was doing compared to other people. Maybe he had been lucky. And what he started to do was he changed his strategy. He pulled back. His target had originally been 75%. He'd consistently been able to trade and do the work and put the risk on that was commensurate with the goals that he had set. So if you have a goal, you have a plan, then you need to work the plan, and you really have to be committed to it. This guy, somewhere in the course of the year, lost his commitment. And by commitment, I mean the real belief that you're going to be able to do it, which means you've got to reduce your inclination, which is very human, to hear what other people think. Anybody has a negative idea, anybody sort of questions your willingness to go for the gold medal, you've got to stop having that kind of conversation, because it's very easy. It's like a poem. If you say, the cloud is gray, and you kind of feel the poetic impulse, and, this is really going to be beautiful. You say to somebody, I got this poem, the cloud is gray. That's a lot of nonsense. And it kills the inspiration. And so believing in the outcome becomes critical, even though what you're thinking is something that everybody else thinks is absurd. All the best guys, they're losing money. Why aren't you satisfied with 40%? So now that's a tough conversation, because how can you tell a guy who's doing 40% that he's not committed? Well, when you dig a little deeper, he was not committed to staying on the target that he had. If he had done that, he might very well have gotten to the 75%. So one way of dealing with stress is to have a plan and then work the plan. This pilot, Sully, I mean, he'd been training all his life for this one event. Gliding pilot, gliding experience, his experience as a fighter pilot and all that. He had about 3 seconds over the George Washington Bridge to make the decision to dump the plane in the Hudson, which was very uncomfortable for him. I mean, days later, he was still feeling like he'd done something wrong, even though he'd done this extraordinary thing. So it's the training, so that when you're in the stressful situation, you start focusing. I said this before, one way of dealing with stress is to practice meditation or yoga or prayer or any one of a number of things where you can kind of calm yourself down so that you're really able to fully attend to what's going on. Most of us don't do that. But when you get into the stressful situation, you're not going to have the time to start learning how to do it. So it's almost a kind of a mental exercise that should be practiced daily, so that you go through the day in a somewhat tranquil state of mind, with a great sense of equanimity, so you can see things for what they are and not overreact to them. Like, some guy, a European billionaire, lost a lot of money and killed himself. He obviously didn't see that life may really be closer to the myth of Sisyphus, where you push the boulder up and the boulder comes down. You push it up and it comes down, and you don't really know what is life. Is it when you're pushing it up, or when it's coming down on top of you, or maybe it's all of that? And so that you begin to develop some ability to detach from the overinterpretation that you put on events, which is what leads people to feel embarrassed or humiliated and so on. I talked to this Swiss fund manager, and he said he was going to a dinner where he was going to meet a lot of his investors, and what was he going to do? I said, well, because he continually feels obliged to explain what he did wrong. I said, the thing to do is to tell them what you have learned from the experience, that you need to hire a certain kind of person, that you need to concentrate on what you're best at, and that having learned that, you're very positive going forward in terms of what you're going to do. So as horrible as it was, it's been a great experience. He came back from that dinner where he'd raised money instead of having lost money or having gotten more redemptions because people were going to buy into his mental frame. So if he was confident, he had a plan, he had overcome adversity, they were going to hear that. It's the ping in the guy's voice that you hear. It also helped him because he began to feel better as long as he could be proactive. And he had to begin to see, and it's taken a number of conversations, that he creates the feedback that he gets. That to some extent we're all responsible for what happens to us. And that's probably the best answer to how do you handle your investments.
Thank you. Well, thank you very much, Ari. Richard?
Okay, I'm a professor. We're used to speaking for an hour and 15 minutes. They wouldn't give me that. They wouldn't give me PowerPoints. They said I could have a one-page handout. So that's in front of you. So For a couple of decades, I've been running a program on investment decisions in behavioral finance. And it's sort of a counter-indicator as to how the stock market is done. When the stock market is doing very well, and I would say psychology is playing a very major role in the stock market, people generally conclude that they're geniuses and that there's no reason to assume that psychology has boosted the market, and that's the reason that they've done well. But we do very well in eras when there's sort of panic, when things have fallen very considerably. If you look at the top diagram on my page, which I call the fat seagull, the vertical axis, how high it is, tells you the psychological component of the market. The horizontal axis gives you the price to value ratio of various securities. So that in 2007, there was a lot of euphoria in the markets. I mean, a good example would be the price of commercial real estate, the price of buildings relative to rents. And when that's very high relative to historical norms, there's a lot of psychology going in the markets. And even some of the smartest real estate investors in New York City will sort of say, well, 2 years ago, things were selling for $700 a square foot, and then it was $900. I could buy it for $1,000 a square foot because it's going to $1,100. And that didn't exactly happen. There was a lot of psychology in the market, and that was afflicting even the most, significant practitioners in those markets, not unlike what happened to the heads of many of our financial firms in this last year. And if you look at something like the stock market of 2009, which is when a price-to-value ratio is relatively low relative to recent times, then there's a lot of panic in the markets, and psychology is also playing a major role. So today is a good day to be talking about psychology and financial markets. And then the figure below that, that looks like your usual bell curve or normal curve, which you're all familiar with from high school. But what I want you to notice is I put a label there, fat tail distribution, and that there's more density. Things are higher up out in the tails than we see. And what that means is basically, you've probably read the lesson from the Black Swan, but unusual events are much more common than we think they are. And we're used to thinking of the normal distribution, and the way I like to think of it is, we know that the average woman in the United States is 5 foot 6 inches tall. There's 2-inch standard deviation. And we know that the next person walking through that door will not be a 12-foot woman. Right. The stock market gives you the equivalent of 12-foot women. It goes down more than people can possibly believe, given the usual movements that we see in those markets. And similarly with regard to real estate prices and lots of other things. We've just heard a little bit about stress. I want to try and run an experiment in real time, and I'm going to give you 1 minute. So I want you to turn your sheet over and answer. This is a stressful situation. It's about administering a shock and how much you would charge to be the recipient thereof. So just read that and think of your answer. In a minute, I'm going to turn back to what I'm going to be saying. Okay. By the way, you can see if you come and you present questions like this, why they never invite you back. But anyhow, I want to ask a question here. I'm going to just try to get a feel for the answers. I can't do it in real time. How many people here answered less? And you can get a few choices. How many people answered less than $1,000? Okay. How many people answered less than $100? Okay, so let me just tell you the purpose of this experiment. I'm not. How much? $2.40. $2.20 or $2.20? $2.20. Okay, $2.20. Okay, you'll get it. That means you get 20% of all the shots of everybody in the room, right? Okay, let me tell you the purpose of this experiment. The people on this side of the room, the answers weren't too dissimilar from here. People on this side of the room were asked how much you would charge to have a 1% probability of a shock. The people on this side of the room were asked how much you would charge to get a shock for sure. Okay? So, in theory, the answer over here should have been, maybe 100 times as high, but at least 30 times as high as the number over here. We've run this experiment many times, and the answers overlap dramatically. I mean, the same thing. And frequently, there's no statistically significant difference between the answers on this side of the room and the answers on that side of the room. The explanation for this is that when you put people in an emotional state, they ignore probabilities. So it didn't matter whether it was 1% or 100%. Oh my God, maybe I'll get a shock. Over here, it's, oh my God, maybe I'll get a shock. Over here, oh my God, I will get a shock. The shock isn't so severe. And I argue that that's a lot of what happens when markets go to either unreasonable values or to exceedingly low values. People are in such a stressful state that they lose track of what would be underlying fundamentals. And I basically think that probabilities are everything in a stock market. So people just don't focus on the probabilities. A good example would be, well, we have this subprime crisis. How likely could that lead to the collapse of some of our most significant financial institutions? Well, it can't happen. That's the answer is it can't happen. And people didn't bother to decide, well, maybe is it really 0.001%, in which case I'll hold on to Lehman Brothers, or is it maybe 3%, in which case I should get rid of Lehman Brothers? And people didn't go through that type of analysis. Let me give you another experiment which shows, we're not going to do this, but I will explain how it would work, which shows also what I think may have gone on, lessons from the fall, which is you've all heard of the book, The Wisdom of Crowds. And I wish I had written it because it was a bestseller. But I've got an even better book, which I haven't written yet, but I'm going to get Jason to write it with me, which is called The Stupidity of Herds. And now we're going to do an experiment, and this is going to take you back to high school. I've got 2 jars of marbles in the front of the room. And this jar of marbles is 2/3 red, 1/3 green. And this jar of marbles is 2/3 green, 1/3 red. And I'm going to, mix up the urns, put them below the table, and we're going to pick up one at random. And you're not going to know whether it's the greenish urn or the reddish urn. And then each person is going to have to bet as to whether it's the greenish urn or the reddish urn. But I'm going to make it easy. I'm going to let you pull out a marble, look at its color, and put it back so you have a little bit of information. In fact, if you get a green marble, there's twice the percentage in the greenish urn as the reddish urn, so that's a hint that it's the greenish urn. So I asked the people to pull out the marbles, and we start with my friend David Jarvis over here, and he gets a green marble, and he puts it back, and then this gentleman gets a green marble, and he puts it back, and then you get a red marble, and we go around the room, and in fact, 62% of you have red marbles. So it's exceedingly likely that if 62% of the people in a room with 75 people in it have the reddish marble, then it's the reddish urn. But I'm going to start over here, and I sort of say, you can't look at anybody else's marble. And I say, what urn do you think it is? What color? What do you think is the urn? And David says greenish, and this gentleman says, geez, he said greenish, and I've got a green marble, so I'm going to say greenish. And then we come to the third gentleman who's actually even wearing a red tie. He's got a red marble. And he's very smart. He does the calculation. He says, no, wait, there were 2 green marbles ahead of me, and I've got a red marble. There's more evidence for green than there is for red. So I'm going to say green. And actually, the correct thing for everybody to do, going by their little scrap of knowledge, having heard the previous answers, is to say greenish. So the whole room says we think it's the greenish urn. And if we brought an outside observer in here, they would be quite confident that it was the greenish urn. In fact, we had plenty of evidence that it was the reddish urn. And that's the way herds operate. One of the most remarkable experiences I ever had was we were in East Africa. We were driving a Volkswagen Beetle, and we were watching a herd of wildebeests. And the wildebeest, it's not like lemmings running to the sea, but the first wildebeest in this herd sort of ran over a cliff. And then he was followed by another 100 wildebeest until the wildebeest sort of turned off a little bit, and the last 3,000 wildebeest didn't do it. Fortunately, there were probably 50,000 wildebeest in the herd, so that if you lose a few hundred going over the cliff because they follow one after another, it's not so serious. And that's a little bit, I think, of what may have happened in financial markets in the last year, which is that everybody else is investing in these securities that they don't understand. I have to keep up with the herd. They're all earning, X percent a year. I can't fall to X minus K percent a year. I have to stay up with them. Jason knows that it's safe. Ari knows that it's safe. It must be the right thing to do. It's the only way that I can keep up with them. Now, in fact, the way that Jason knew it was safe is because he said Richard knows it's safe. And basically, nobody knew it was safe. Only the first two people in the room were going on, sort of their own information. So I think that you should really, in order to understand what's happened, is we should see that there's sort of herd behavior. I also think there's a lot of extrapolation from recent experience. About 5 years ago, I don't want to ask this question because I get an unpleasant answer, but about 5 years ago, we went around and we asked people, how do you think the stock market will do over the next 10 years? And if you ask people who were, 28 years old, who had maybe 7 years of investing experience, they would say 10 to 12% a year. If you ask people who are 70 years old, they were actually pessimists. They would only say 8% a year. But basically, everybody was sort of a prisoner of his or her experience, and they were extrapolating from recent experience. I have people at my school who have, asked me, well, what should I do? Should I, I just lost 40% in my 401k. Should I stop saving and go and spend the money because at least that way I have the goods? By the way, my recommendation was that's not the strategy that you should follow. We're really good. I'm an academic. I'm particularly good at this, at sort of retrospective analyses and reassure myself that I understand what's happening. Now, I know you can all point to Nouriel Roubini or Bob Schiller, but basically, if you look at the smartest people in Wall Street and the smartest people in academia and the smartest people in government regulators, no one foresaw what happened in 2008. And now there's a small industry of people. I'm part of the industry of people who go around and explain why, given the circumstances that were prevailing at the end of 2007, 2008 was the logically following event. And I think that that's just not true. Historians don't like to do this, but I think that all history should be written probabilistically. And they should sort of say, at the time, if you had looked at everything, what probability would you have assigned to the outcome that you've seen? Now, I think that frequently, standing outside of the events, you can see a lot more than the people who are embroiled in the events could see. But we certainly aren't perfect forecasters. By the way, I'm an economist. I want to blame my profession. I'm a microeconomist, so you can't blame me particularly. But my friends who are macroeconomists all told me that things like 1929 or even half of 1929 could never happen again because we just know too much about the economy. Now everybody is sort of sobered up and we sort of say, well, we can have something like this, but we've really learned from what happened in 2008 and 2009. And I assure you by the time 2016 comes, we will say we really understand how to deal with that. That can't happen again. And by the way, that's true. That particular problem won't happen again. But there are financial crises, just like this financial crisis, that happen regularly. In the 1997 Asian problem, it didn't happen here, but was the same sort of thing. Indeed, I want you to look at the bottom of my page, and I have the top two events from a variety of things. So I have the top two wildfires and the number of acres that they burned, the top two earthquakes in terms of the number of people who were killed, and the top two terrorist events in the United States in terms of the number of people that were killed. And the thing that you see there is that the top event is somewhere between 3 and 15 times larger than the second largest event. And I used to study terrorism, but that sort of got too exciting, so I moved to finance. But when people were saying in 1999 that terrorism can't happen, domestic terrorism can't happen in the United States, that was, in my view, complete nonsense. Already Al-Qaeda had blown up 2 of our embassies simultaneously in East Africa. Now, which they did with trucks and fertilizer. Is there more trucks and fertilizer on the Jersey Turnpike or driving around East Africa? I think there's more, on the Jersey Turnpike. So, you couldn't have foreseen that the guys were going to get on airplanes and crash them into the World Trade Center. But you could think of, if 200 people have been killed in a terrorist event, it wouldn't be surprising if it was 3,000. And the bad news for this morning is it wouldn't be surprising if in the next 10 years we had a terrorist event where 30,000 people were killed. Or, for that matter, 300,000 people were killed. Okay, let me just close with an area where I've been doing some research recently, which is on trust and trust institutions. And a major finding from that research is that people are a lot less willing to take a gamble where they're gambling on another person being trustworthy than when they're gambling with equivalent odds on a red marble being drawn from an urn with a certain percentage of red marbles. So as I said, we're playing a game, and do you want to trust a random person on the other side of the room? And by the way, 30% of those people have been trustworthy. Or would you rather, with the same payoffs, draw a marble from an urn where 30% of a red marble from an urn where 30% of the marbles are red? Most people would far prefer to draw the marble from an urn. There's a concept of betrayal aversion. Okay. In the last year, we've been severely betrayed. And I don't mean betrayed by Bernie Madoff. That was a tiny percentage of people who were betrayed by Bernie Madoff. But we've been betrayed by our major financial institutions. It used to be that you got a document and it said Lehman Brothers on it, or Bear Stearns on it, or AIG on it, and you sort of said, this is reliable. Now, Goldman Sachs didn't fit into that category, but can we really be confident that Goldman Sachs is reliable? We certainly can't. There's probably somebody here from it. We certainly can't be confident that what Moody's says is reliable. And there's an externality from when one group of trusted people betray us, we think that a very broad group of people who we have trusted will betray us. And I think that this is a serious question as to how long will it take us to put the genie back into the bottle so that the American public, or for that matter, the world public, can trust again. Thanks very much.
Richard, thank you. Jason?
Great. Well, Richard, thank you. You cheered us all up with fears of terrorism and betrayal. I thought I would talk about just a couple of quick themes, because I know we want to save plenty of time for questions. But first of all, I hope you can all hear me through my sinus infection. I'd like to talk briefly, I think, about just some simple neuroscience findings about greed and fear. Greed is not much with us today, I guess, but fear is very much part of the environment. Let me talk about greed for a couple of minutes. It's been very well understood for about a decade the way the brain forms expectations about future outcomes. Oh, thank you, Steve. Okay. Let's do this. Is that better? Okay. What I said earlier, by the way, was blah, blah, blah.
Brilliant.
All right, now I'll get good. It's been well understood for about a decade how the human brain forms expectations of future outcomes. And there are three basic responses in the brain that I think are helpful to know about. they all involve what's often called the dopamine system, which is a set of neural circuits we possess and share in common essentially with all vertebrates. And at the top of your brainstem is a small set of cells called the ventral tegmental area where dopamine neurons originate. And you can best think of what's going on very much like the snap of a whip or the motion you might get in a garden hose if you give it a vigorous shake. Essentially, these neurons, when they become aware of something important in the environment around you, they emit an electrochemical signal, an action potential, and at their resting rate of firing is roughly 3 to 4 times a second. Pop, 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 pop. But when something potentially rewarding occurs in the environment, the firing rate of these neurons jumps roughly tenfold, roughly 40 times a second. Pop, 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 pop. So that whip, that garden hose, is firing like this now. And the first response in this system that's interesting is that when an organism encounters an unexpected reward, or a reward that's larger than expected, the firing rate in the dopamine system just jumps almost instantaneously. In roughly a quarter of a second, you get about a tenfold gain in the response rate of these neurons. And that's the brain's way of signaling and ultimately remembering that something important has occurred that may be potentially rewarding in the future. If we couldn't know or remember when we've encountered something in the environment worth approaching, we wouldn't know to approach it again. The second element that's interesting is that once you've been exposed to a handful of similar experiences, let's say, for example, that I give each person in the room $1, but I only do it when I raise my right hand. After I do that a couple of times, 3 or 4 times, every time, if I even just scratch my ear, everyone in the room is going to be expecting $1. And in fact, what will happen is the dopamine system in your brains will respond not when you get the $1, but when I raise my right hand. And this is very important to realize. This has been shown in monkeys. It's been shown in humans. Ultimately, I think it'll be shown in just about every creature with a backbone, and many humans without them. And what it tells us is that the ability to identify a predictive cue, the ability to sense that a reward is in the air, is itself rewarding. There's something intrinsically rewarding about knowing that you may get rewarded. And it's an extraordinarily powerful response. And in a way, it's not surprising. It's everyone remembers from high school biology class or psychology Pavlov's famous experiment with his dogs, who ultimately ended up salivating not when they got the food, but when they heard the bell that signaled that the food would be coming. And in fact, you can take this, as I'm sure Richard was about to point out, to multiple iterations. The dogs would salivate when they heard the footsteps, indicating that Pavlov or one of his lab assistants was walking toward the bell. And ultimately, they would even respond if they heard the door open down the hallway, meaning that the footsteps were about to come. And investing works very much this way, if you think about it. We have the formation of the analyst's consensus for earnings on Wall Street, so that the stock will rise not when it beats the consensus by a penny, but rather once everyone realizes there is a consensus, and ultimately it moves back even further and further. And it's actually the cue of the prediction that itself gets the dopamine system churning. So you're looking to identify a hedge fund manager who can reliably produce alpha. You may get excited not when you think you've actually identified him or her, but as soon as you realize that one or more of the typical signals are in place. So you like the organization, or you like some particular statistical measure you're using, you may already be on the hook before you've even done half your due diligence, because you may sense from your past experience that enough factors are in place for you to know what's coming. And then the final element here, excuse me, is what happens when the reward that you expect to receive does not transpire. And in that case, what happens is, as normal, if you expect the reward and you see the cue that normally predicts it, your dopamine system will have that same positive response when you recognize the predictive cue. And then at the moment when you expect the reward to be delivered, when your next account statement from, Bernard L. Madoff Investment Securities is due to arrive in the mailbox, and instead you open that day's issue of the Wall Street Journal and there's a front page headline about how Bernie Madoff has confessed to a $50 billion Ponzi scheme, your dopamine system essentially shuts down and your brain falls into a kind of motivational vacuum, which then is very rapidly filled with a stress response. And the key here, I think, is to realize that as investors, what we need to do is to have the discipline to buy low and sell high, but the brain is actually designed much more naturally to give us a result of buy high and sell low. We tend to get carried away by enthusiasm at exactly the wrong time and to be swept away by despair at exactly the wrong time. And let me just close with a couple of thoughts about fear. It's not particularly controversial among neuroscientists that at least one of the main brain structures involved in mediating the emotion of fear is called the amygdala, which is, again, like the ventral tegmental area, a very ancient and evolutionarily conserved brain system that we share with just about every other vertebrate, and many non-vertebrates, actually. And the amygdala, in my mind, is noteworthy for how rapid a rapid response system it really is. One of the fundamental tenets of neoclassical economics and modern portfolio theory is that people are rational agents, which I don't have to look at Richard to know that he's smirking. And one of the central aspects of being a rational agent is being able to make a judged, a disciplined mental trade-off between risk and reward. Whenever we're confronted with a decision, we should always make a cost-benefit analysis. But the amygdala works so rapidly, fear is such a natural self-preservation mechanism in the human brain that I would argue at times of real market terror, like we saw last fall and arguably we may still be in, it's extraordinarily difficult for people to make a cost-benefit analysis because they can't think about the benefits. All they can think about is the costs. Why is that? It's because the amygdala is such a rapid response mechanism. It's been shown in countless experiments that this part of your brain registers a fear response to all kinds of stimuli. Natural stimuli that are intrinsically frightening, like charging lions, lightning, fire, snakes, It's a rubber snake, by the way. And Richard's going to see his cardiologist later. But also to social or interpersonal stimuli, like a stock market crash, for example. And the amygdala will fire in moments when you're confronted with a fearful stimulus in as little as 12 milliseconds, which, to put it in context for you, is about 25 times faster than you can blink your eye. So, for all his experience, Ari flinches a little if somebody throws a rubber snake at him, and he doesn't have time in 12 milliseconds to say, well, what are the probabilities that I'd be sitting in the Bruce Museum in Greenwich and one of my fellow speakers would throw a living rattlesnake at me? Well, the probability of that is 0, therefore I won't flinch. That's not the way the human mind works. Even a human mind as finely tuned as Ari's, I dare say. So, one of the keys... Yeah. One of the keys, I think, and Ari touched on this earlier, is that the time to rehearse worst-case scenarios is not when things go bad, but rather when everything is going well, just when it's least likely that it would ever occur to you that you have a need to do so. And I think that's the trouble that a lot of people found themselves trapped in, say, 2007, which is why prepare for the worst when, so far as the eye can see, it's nothing but blue skies. So, enough for me.
Jason, thank you very much.
Thank you.
I think we should open this up to questions.
I have a question for the professor. The implication of your top 2 events is to create the impression that sequentially things are getting worse, when in fact your Nevada fire actually occurred after the Yellowstone fire, and why can't we be headed in the other direction?
Oh, we can be headed in the other direction. I mean, my point is just unusual things happen more often than you expect. So if you ask people in this room, this is an experiment we sometimes do, to write down where they think the stock market will be on December 2009. And then you sort of say, what's your best guess? And what's your 25th percentile? Only what chance for it will be that low? And what's your 1% surprise point? It's only 1% likely it's going to be that bad. And then your 75th percentile and your 99th percentile. 99th percentile, it can only be, there's 1% chance it will be that good. And you warn them. I said, you're going to set your confidence intervals much too tight. My argument is, it's much more likely that 2009 is going to be a disastrous year, worse than your 1% point, or that it's going to be a spectacular year, better than your 99th percentile. And when you hear people on television, they say, what's going to happen to the stock market now? All sorts of people sort of say, well, it's at 7,500. I'm predicting for the year that it will end the year at 8,200. And I would answer that, if that was my belief, I would sort of say, my best guess is 8,200. But I think it's 25% that it's going to be over, 9,500. And it's 25% that it's going to be under, 6,500. So I'm just sort of saying extreme events, both on the good side and on the bad side, happen more than people think. So I'm not an Eeyore. I'm just don't be so surprised. I was sort of expecting Jason to throw a real rattlesnake. I was disappointed.
Sure. I guess the presentation reminds me of the concept 5 Ps, proper preparation promotes positive performance. And actually I want to pick up on the question you had, Professor, and speak to it. Can we ever trust again? Trust is an interesting word, 5 letters. It's got the same number of letters as money. Alpha. Something talks about this. I'll give you a couple quick word pairs and ask a question. it seems we have to go from lying to faith. We have to go from greed to honor. We have to go from fraud to trust. You talk about behavioral aversion. I'm curious. Is it different this time than 74, 87, 98, the noughts? Didn't we recover at those periods? Have we destroyed faith that much compared to those 4 other time frames in the 4 decades? Give us a flavor of that.
Well, first place, this guy's great at wordplay. I'd like to, sort of do crossword puzzles with him or something like that. Yeah, I think it's worse. I think it's worse for a couple of reasons. One reason is it's affected a much broader swath of the community. I mean, the previous, more and more of the nation has been invested in securities. We've always said with great pride the percentage of Americans who own securities, and that's been going up and up and up and up and up, and now a large number of them have been hurt. Similarly, with regard to the number of people who've owned their homes. As you know, over the last decade, the savings rate in the United States has been 0. But people have been building up equity because the home that I bought for $100,000 in 1973 is worth $600,000. And now all the people have seen the value of their home fall significantly. The other notion is the betrayers have been much more widespread throughout the society. And by the way, Time magazine had the 25 people who were responsible. I think that was completely unfair. I think that there were, 25,000 people responsible, including, everybody in this room probably, because, Jason's articles, he didn't get enough prominence for them. I wasn't writing articles explaining that this was about to happen. So, and whichever group you're suspicious of, whether it's government or the leaders of business or the leaders of financial institutions, all of those people have disappointed us. The other thing is, it's what have you done for me lately? I mean, people don't, you may say 1974 was much, I remember it was much worse. Most people can only remember what's happened in the most recent period. So I assume that this will have an effect that will last for, a significant period of time until I think mostly we're going to be developing new institutions which we're going to start to have confidence in. And we're going to reassemble in this room in 25 years, and you're going to sort of say, how could you be so stupid to think that that institution that we created in the, 2010, and which reassured us for 24 years, it was going to betray us too. Because I think that, every institution, every individual, in some circumstances will look as though it's betrayed. So on that, I'm not a pessimist with regard to this gentleman's question. I am on your question.
Ari, if you're coaching a trader who's never before been exposed to the sort of science of the behavioral heuristics and the impact of stress on trading, is there some benefit they get just from the awareness of those mental dynamics, or does it all come from practice?
No, I think awareness is critical to the extent the usual response of most people is to try to mask it, to hide it, to deny it, and so forth. And the more you suppress it, the more it percolates throughout the system and starts showing up in terms of trouble sleeping or appetite changes and so forth. So even if somebody doesn't practice some kind of meditative practice or relaxation practice, it's really useful. And if you go over to SAC, where I've been working for about 17 years, the vocabulary of everybody is full of psychological talk. So the more people can talk about what they're experiencing, the more they can distance themselves from it, the more they can act independently of how they're feeling. The pilot on 60 Minutes said, I never felt so bad and uncomfortable in my life as when I realized our engines were out. And then my training kicked in. So the first thing is being aware of it, being able to identify it, and recognize that it's human to experience all these things, because it's all built into the amygdala and the dopamine system and so on. I don't think you have to understand the neurochemistry, but to the extent that you understand that to be human is to be fearful, to be greedy, to be all these things, and then to have a plan and have a strategy and do the kind of work that's necessary to understand what's going on in the market quite independently of what you're experiencing. Because to the extent that you're experiencing it, it's coloring the way you interpret things. It's coloring, you say, my God, I don't want to look like I'm a wimp, or I don't want to look like I'm this, I'm going to double down, or I'm going to swing for the fences. So you need people to learn not to be reacting to their own responses, not to distort what they see, and not to cover it up vis-a-vis how other people see them. It's okay. The toughest guys are the guys that can really acknowledge their fear. You talk to Marines or SEALs, they're comfortable talking about it because they've developed some techniques for mastering it, and one of the techniques is recognizing it.
Has any work been done on how long it takes the herd to heal? How long did it take before 9/11 became something that didn't worry people? How long did it take before the various busts in the past?
I don't know the answer to that, but I would say this. One of the things I've encouraged people to do is when something bad happens and you're starting to experience great distress or panic or anxiety or anger or whatever it is, take out your watch, write down what time it is, and then just stay with that feeling.
But that's a trading situation.
No, but it's true in life too, in the sense that if you can time your distress, then you will ultimately discover that it's time limited, that it doesn't last forever. Maybe it lasts 3 hours, maybe it lasts 5 hours. The next time the same thing recurs, you can say, oh God, I've got enough 5 hours of distress. That second time, it won't last 5 hours, it'll last 3 hours. You keep doing that, eventually all you feel is the ping, and it's gone.
I understand that. What I'm interested in is the macro.
The herd, unfortunately, the professor could probably speak to this, the herd doesn't really acknowledge this kind of stuff. They don't do it. If they all did it, it would last a much shorter time.
Oh, well, I don't have anything brilliant to say on that, but let me make two comments. One, after 9/11, I spoke to psychiatrists are really smart. They understand what you're thinking about. I spoke to the smartest psychiatrist that I knew at Harvard, a man named Miles Shore. And I sort of said, everybody here is talking about 9/11 all the time. Well, what happens to people who live in a circumstance where they're getting bombed all the time, where they're always at risk of death? He said, they get used to it. And the answer is, if there's the same type of stress that you're always subjected to, then you can get used to it. And that may be what Marines do. The trouble is if you face this stress where people may hold you up in the park, you face this stress where your portfolio may go away, you face this stress where a snake may come up and bite you, it's an awful lot harder to do. I just sort of say on herds, every university in the United States, every leading university, is trying to teach a course on leadership, and almost all of them are having a terribly hard time because nobody knows much about it. And the thing that helps the herd heal is effective leadership. And when we grade Barack Obama after his first year in office, a lot will have to do with whether he's managed to calm the American public or frighten the American public or make the American public feel, uncomfortable or comfortable. So we know that leaders are terrific at that. Churchill was, maybe the best. But it's not obvious that we have such leaders in the financial community. I hope we do.
Yeah, I'd like to add just one quick note on that. I think what Richard said is excellent. And he put me in mind of another point, which is some of it is cultural, too. Different societies respond better or worse to mass trauma. And if you look at Israel, for example, which immediately came to mind when Richard talked about September 11th, My half sister is Israeli, and she called me during the Hamas conflict, and actually before the Israeli army went into Gaza, while the Hamas rockets were still dropping in Israel, uncontested, and I said to her, "Oh, how do you feel about your safety?" And she said, "Oh, the rockets they're nowhere near us." And immediately my antennae went up, and I said, "Well, how far away are they?" And she said, "Oh, the nearest one landed 3 kilometers away." And to her, that was nothing. And of course, if you were an American and rockets were landing 3 kilometers away, it would be a very different story. And I guess where that brings me out is that part of the answer to how well the herd will heal is how resilient we've learned to be as an investing culture. And I think investors learned to buy on the dips in the 1990s and the 2000s. I worry a little that they don't fully understand that dips can be a lot bigger than they sound and last a lot longer than you might think. And we may, we'll know soon enough. But I think the safer bet is to be pessimistic on that one, not optimistic.
Any other questions?
What did we do wrong? Was it the snake?
They've been programmed. A couple housekeeping. Can I borrow your mic? Sure. A couple housekeeping items.
If you would stay, don't leave the room. Thank you. They're obviously not members. They'd know better anymore. Exactly. Somebody, a wise trader once said, I just want to echo a lot of the comments, was to write your thoughts and feelings in a journal as we go through these market ups and downs, especially as an LP, because we're not in the business of buying instruments. We're in the business of buying people. So we have to be psychologists, sociologists, and anthropologists. But someone smart said, write it all in a journal now and revisit it. Secondly, I want to thank everybody who's made a contribution to the roundtable. As you know, we lost our underwriters. Our funding is probably fallen off a cliff, and those of you who wrote a check, bravo. Thank you very, very much. And Ted Seides has led our programming committee masterfully. Ted really focused us on the subprime phenomenon 2 years ago, but he's taking a shift in the programming. Ted is now focusing on the opportunity. So we're not going to meet in March because we don't have an underwriter, but we will meet in April. On April 19th, we'll meet, and the subject will be opportunities along the credit capital structure. So stay tuned to your email for that invitation. Finally, I just want to mention, I see a lot of new faces here. Those of you who don't know our protocol, and it's in the membership policy, but the members sit in the inner ring. Guests are in the back, but the inner ring is for the members of record. So just pass it on to your guests if you do invite, or your colleagues who come. Finally, we're forming a committee, the Next Best Practices Committee, and this is going to be on venture capital. So the title of the study will be Best Practices in Alternative Investing, Due Diligence for Venture Capital and Private Equity. If any of you would like to participate in that committee, please let me know, or Vaso. Peter Lawrence is co-chairing that committee. And finally, I do want to thank our underwriter today, a new friend of the roundtable, Jack Rubin at Credit Suisse, and we're very grateful to him for coming and supporting the roundtable. And Jack, would you like to say anything to the members?
Very brief. Steve, I'd like to thank you and the whole panel for allowing us to host today. Credit Suisse is a reasonably new entrant into to Greenwich in the private banking area, having been here since 2007. And the only other thing I'd like to ask is, Ari, if you'd given me a heads up, I would have brought over a stack of Credit Suisse yoga mats that we could have had as favors on the way out. But we'll do that next time. So thank you very much.
And thank you, Jack. And Ben, again, I want to compliment you on the panel today. It was excellent. Look forward to seeing more of you. Ari, Jason, Richard, good job. Thank you.